Almost a year ago, I discovered something that changed my entire perspective on income investing: YieldMax ETFs. These beauties were printing money like nothing I'd ever seen before. We're talking about 100 plus yields, monthly distributions. That's pure income insanity. For nearly a year, I ran what I call my psycho experiment with these funds. And let me tell you, it worked exactly as I planned. Monthly distributions rolling in, massive yields being captured, pure income generating power. But there was just one problem. These US-based ETFs are only available to professional investors from Europe. For most European investors, these yields were just a dream they couldn't access. Then, something incredible happened. I discovered IncomeShares, Europe's first option-based ETPs targeting individual stocks. It was like finding the holy grail of income investing. Same concept, same strategy, but fully accessible and even better. They are Irish domiciled, which means better tax efficiency for European investors. It was like YieldMax evolved into its final form. So I did what any psycho investor would do: I dove in headfirst. And today I'm going to show you exactly how these funds work, why they generate such insane yields, and how you can use them to create your own income generating machine. Look at these numbers because they are going to blow your mind. Tesla Options ETP, 87% yield. Coinbase Options ETP, 92% yield. And these aren't some sketchy crypto yields, these are regulated ETPs trading on major exchanges. Let me show you exactly how these beauties work, because this is where it gets interesting. IncomeShares uses two main strategies. First, we've got their covered call strategy. They buy the underlying stock, let's say Tesla, and then sell call options against those shares. But here is where it gets psycho. They are optimizing these options based on volatility patterns to maximize our income. Let's break down TSLE, their Tesla ETP. When Tesla stocks goes crazy volatile, and you know Tesla loves to do that, this fund is collecting massive options premium. While everyone else is trying to predict if Tesla is going up or down, we're getting paid either way. And check this out. We've got METI for Meta, NVDE for Nvidia, KOI for Coinbase, each one targeting different volatility patterns, different market sectors. This isn't just yield chasing, this is portfolio engineering at its finest. Now let me tell you something most investors miss completely. These funds are something called active options management. They are not just blindly selling calls, they are adjusting strike prices and expiration dates based on market conditions. The more volatile the stock, the higher the option premiums. That's why we see yields like TSLE over 87%, KOI over 92%, NVDE at 35%, and Meta at over 25%. But let's talk about risk management, because this is crucial. These aren't your typical buy and hold ETFs. When you sell covered calls, you are essentially trading some upside potential for immediate income. Here is how it works in different market conditions. In bull market, we might underperform the underlying stock but still collect massive premiums. In bear market, our premium income helps offset some downside. And in sideways market, this is where I absolutely shine, collecting premium after premium every single month. And here's something special for my European psychos. These ETPs are Irish domiciled, which means no withholding tax on distributions. That's right, you keep more of your psycho yields. Let's talk strategy selection. IncomeShares uses two approaches: covered call strategy for single stocks, cash-secured puts for indices, QQQY and SPYI. Position sizing is crucial here. Look at how I structured these in my portfolio. Higher volatility plays, TSLE, KOI, smaller position. Lower volatility plays, AAPI, MSFE, can go larger. Index-based strategies, QQQY, SPYI, core positions. The mechanics are beautiful. Take their zero DTE, 0 days to expiration strategies on indices. They are selling puts that expire the same day, maximizing that theta decay while managing risk through position sizing and active management. And here's what really makes this cycle: the income frequency. We are not waiting for quarterly dividends here. These distributions hits our account every single month, creating a consistent income stream that lets us compound our gains faster. Now let's talk about costs, because this matters. 0.55% for single stock strategies, 0.54% for index strategies, and 0.1% 3.5% for commodity strategies. That might seem high compared to vanilla ETFs, but when you're generating 50% plus yields, it's absolutely nothing. Look, these aren't for everyone. If you can't handle seeing positions move around while collecting massive yields, stick to your 2 to 4% dividend stocks. But if you are ready to generate serious income while managing risk like a pro, IncomeShares is your tool. Now, let me tell you something that most investors completely miss about these ETPs. It's all about option moneyness and how these funds maximize our returns. When IncomeShares sells covered calls, they typically targeting ATMs, at the money options, to slightly ITMs in the money options. Why? Because this is where the juice is. ATM options gives us the highest eccentric value, which means maximum premium collection. Let's break down a real example with Tesla. With Tesla trading at $400, they might sell calls at 400 or 410 strike. This gives us maximum premium collection potential, some upside participation if we are wrong, optimal position for time decay. But let's talk about market timing, because this is crucial. These ETPs perform differently in different market cycles. During strong bull markets, we might see some underperformance because our upside is capped. But check this out. Even in the most bullish scenarios, we are still collecting massive premiums that most investors can only dream about. In bear markets, this is where we really shine. Those premiums we collect, they act as a buffer against market declines. While everyone else is panicking, we are still collecting our monthly income. And in sideways market, this is literally free money. The underlying assets goes nowhere, but we keep collecting premium after premium. This is why I love choppy markets. They are perfect for our strategy. Now, let me show you how I structure my entire options income portfolio using these ETPs. Tier 1, high volatility plays, about 20% of options allocation. TSLE for Tesla exposure, COE for crypto market exposure, and VDE for semiconductor exposures. Tier 2, medium volatility plays, about 40% of option allocation. METE for social media exposure, AMZE for e-commerce exposure, and AAPE for tech giant exposure. Tier 3, index strategies, about 40% of option allocation. QQQI for broad tech exposure, SPYI for market-wide exposure. Here is how I manage this position. When volatility spikes in any sector, I might increase exposure to those ETPs. For example, when crypto gets crazy volatile, COE's premiums go through the roof. That's when we want to be collecting maximum yield. Let's talk about entry points. I look for three main factors: elevated implied volatility in the underlying assets, technical support levels nearby, and buying at ex-dividend dates. Also, these ETPs correlate with VIX. When market fear rises, our premiums typically increase. This is literally getting paid more when others are fearful. Now, for the advanced stuff, managing a full portfolio of these ETPs. Here's my framework on position sizing in overall portfolio. High volatility ETPs, TSLE, COE, roughly 1 to 2% positions. Medium volatility ETPs, METI, AAPI, 2 to 3% positions. Index ETPs, QQQI, SPYI, up to 5% positions. So, with a properly structured portfolio, we can target monthly based distributions and monthly rebalancing opportunities. And don't forget about the tax efficiency. Being Irish domiciled means no double taxations, simplified reporting, more efficient for European investors. Now let me tell you exactly how to execute these trades. When entering a new position, start with 1/3 of planned allocation, average in over 2 to 3 weeks, and use limit orders to get better fills. Now I know what some of you are thinking. This sounds too good to be true. But this is exactly why we are psycho investors. We understand complex strategies that others ignore, and we use them to generate massive income. Just look at these numbers one more time. Tesla over 87%, Coinbase at 92%, Nvidia over 35%, and Meta at over 25%. This isn't some fantasy. These real yields hit in our accounts every single month. And take a look at my income portfolio forecast for 2025. Over $46,000 from roughly $160,000 portfolio after tax That is 8 to 10 times more than average dividend investor is getting with his safe choices. That's how real psycho investors build generational wealth, not by gambling on meme stocks, but by understanding and implementing sophisticated income strategies that most investors don't even know exists. So if you want to learn more about maximizing your portfolio yield, smash that subscribe button, hit the notification bell, and follow my portfolio with the link in the description. See you in the next videos.